Hi everybody, this is Mike, and this is the webinar on Module 2 of the Your Money, Your Goals Toolkit on saving for emergencies, bills, and expenses. This webinar was originally scheduled to be done live on Wednesday, January 31st. However, I work from home, and I've been having issues with internet connectivity problems where the internet connection will go down intermittently for periods of time. I do have a technician coming out this week. Hopefully they can fix the problem. But I wanted to do this and record it and archive it while I had a stable internet connection, so I'm just going to do it a little bit ahead of time. I have a couple of announcements for those of you who are listening in. If you are a VR counselor, you can get CRC credits for listening to this webinar. If you are interested in CRCs, send me an email after you listen to this at Michael, M-I-C-H-A-E-L, Klinger, Klinger, at dars.virginia.gov, and I will make sure those credits get logged in for you. If you are a WISA and you are listening to this, don't forget that you can use participation that you have in any of my webinars towards your continuing ed credits for Cornell. If you have any questions about how to log in your credits into your portal, you can email Ray Sabula's assistant, Michelle Elverd, at msa224@cornell.edu, and I'm sure Michelle would be glad to help you log in those credits. But don't forget that you can count these towards your continuing ed if you are certified through Cornell. So what I wanted to do was I wanted to go through a sample case study I developed in conjunction with the module in this toolkit. And I wanted to do a sample case study to show you guys as practitioners working with clients about how you can apply some of the concepts of your money or goals to a case. So I'm going to start out by just going through the scenario, and then we'll go through some of the suggestions that are made in the toolkit on how to help a client develop a savings plan. So Jane is a 20-year-old with spina bifida. She lives alone and gets $392.50 in SSI, and her SSI payment is reduced because she works part-time, making $800 a month. She'd like to go to school for business administration and hopes VR can help her with the cost of her education and helping her find a job in that field. She doesn't have that much in savings because once she pays for her rent, utilities, phone, and groceries not covered by SNAP, she only has around $100 left. So how can we use the tools in the Your Money, Your Goals toolkit to help her develop a savings plan even though she doesn't have a lot of money to work with? So any of us that have ever tried to save any money know that it's easier said than done, right? You know, you have a plan about how much you're going to put aside, and then the car breaks down, the dog's got to go to the vet, you know, it seems like something always happens. When you're on SSI and you have a fixed income, it's even harder for people to set aside money into a savings plan. So how do you initiate a conversation with a client that wants to save money, doesn't have a whole lot of work to work with, and wants some suggestions on what she should do? What I've done here in the case study is summarize some of the suggestions in Module 2 of the Your Money, Your Goals toolkit. So first suggestion is to start small. If she only has $100 a month, maybe she can set aside maybe $50 a month into a savings plan and work from there. So if she's got a goal of saying maybe saving $500, she saves $50 a month until she reaches that 500. Then maybe she can build up to maybe a goal of saving 1,000 or 1,500 or 2,000. So just because a client doesn't have a whole lot of money doesn't mean they can't develop a savings plan if they start with small obtainable goals. Are there any expenses she can cut? You know, we mentioned in the case study that she's got a cell phone bill. Maybe she's got an unlimited plan and she's got a top-of-the-line cell phone plan. Could she potentially maybe go down to a plan rather than having unlimited where she has a limit to her data and a limit to her minutes? It'd be cheaper, allow her to put a little bit of money into savings. Are there ways to maximize her current benefits, such as the student earned income exclusion? We mentioned in the case study that she's under age 22, she's 20, she's looking at going to school. Could she potentially take part of that $800 she makes and exclude it under an SCIE? Now in 2018, Social Security won't count the first $1,820 of a client's wages against their SSI if they're in school, up to it's $73.50 a year. So she could potentially put aside or have excluded $800 of her wages every month under an SEIE until she reaches that $73.50 max, and not have her $800 a month included as part of her SSI computation. So what that'll do is allow her to receive an SSI check for as long as she uses the SEIE of $750, and she could use the extra money that she's making in that SSI check to maybe put into her savings plan. What about a plan for achieving self-support or a PASS? We mentioned that she's looking at going to school. Maybe she's got school expenses that are more than what her grants or her DARS help covers. Maybe she wants to pay for some books or has some fees that she's got to cover. She could potentially take part of that $800 a month that she's making in her part-time job, put that money into a PASS plan, and just like the SEIE, money that's put aside into the PASS will not count in terms of determining her eligibility for SSI. So she would have more SSI to work with and meet her expenses while she's also saving up for the education expenses that she's got. So that's another option. Or what about utilizing an ABLE account? Most of you who are listening to this probably know what an ABLE account is, but for those of you that might not be as familiar, let me just go through it briefly. ABLE stands for the Achieving a Better Life Experience account, and it's geared towards individuals with disabilities who are on needs-based benefits and want to save more than the standard $2,000 resource limit for SSI and Medicaid. Prior to ABLE accounts, people that were on SSI and Medicaid could not have any more than $2,000 in a checking account or a savings account without impacting their ability for benefits. Now, ABLE has changed those things. And this client does qualify for an ABLE account because she meets some of the criteria. Number one, she's already on SSI, so she's going to be found disabled automatically. In terms of eligibility for an ABLE account, you have to have a disability. And also, she's had spina bifida since birth, and she's 20 years old. So she meets the age of onset criteria too. Regs say that to be eligible for an ABLE account, client has to be disabled prior to age 26. This client is or has been disabled prior to age 26, so she meets all the criteria for an ABLE account. What the ABLE account allows clients with disabilities to do is to put aside up to $15,000 per year into an ABLE account, and any money that is put aside into that account does not count towards eligibility for Medicaid or SSI. Now, those $15,000 annual contributions can either come from a client, they can contribute to their own account, it can come from a family or a friend, but the maximum contribution is $15,000 a year. Any money that's put into that ABLE account can be used for what the regs call disability-related expenses. And what constitutes a disability-related expense is extremely broad. It can be anything that the client could use to make their life better. So, for example, education expenses are a disability-related expense. Housing is a disability-related expense. Transportation is a disability-related expense. There are a wide variety of things clients can use the ABLE account for. Now, if they're on SSI, they can save up to $100,000 in an ABLE account before their eligibility for SSI is suspended. And that doesn't mean eligibility ends. What that simply means is that once the ABLE account reaches $100,000, the client's SSI checks will stop until they spend the balance down below that $100,000 limit. So they can get their checks reinstated once their ABLE account is down below $100,000. If they're on Medicaid, they're allowed to save up to $500,000 in an account without, I should say, if they're on Medicaid and have no SSI component, then they're able to save up $500,000 before their eligibility for medical benefits is terminated. So as you can see, using some of these work incentives, whether it be SEIE or a plan to achieve self-support or ABLE, these are all ways for her to maximize the current benefits she receives and put more money aside into savings. So by using some of these work incentives, you took somebody that only had $100 a month originally to set aside for savings, and you've given her the ability to save substantially more by establishing like a pass plan or an ABLE account. And obviously, most of you who are listening to this already know this, but pass plans, SEIE, ABLE accounts, those are all work incentive specialist advocate services that VR counselors can authorize through Aware to help clients set up these work incentives and navigate through the process of getting them approved. The ABLE account procedure code is A3022 in Aware for any VR counselors that might have clients that you think might be eligible for ABLE and you want AWISA to do a screening. They can do that by using A3022 in Aware as the procedure code. And that would allow the WISAs to not only help the client set up an ABLE account, it's about a 5-minute process. You go to ablenow.com, which is Virginia's ABLE account. The client can set the account up online. And then the WISA would also help the client develop a savings plan, determine how much they were going to put aside into the account per month and what kinds of expenses they were going to use the account for. So the WISA is available to help a client do that. In addition to using some work incentives, could she, once she has the ABLE account set up, could she potentially arrange with the payroll department at her job to have a percentage of her wages automatically put into her ABLE account? Maybe she could, let's say she has $800 of wages. Maybe she decides, I want to put $50 a month into my ABLE account. She can set it up with her payroll department so that $50 of her wages automatically go into the account that she's established as an ABLE account. So that way it makes savings automatic. You know, she gets in the habit of just having an automatic savings plan. She doesn't touch that money, and over time it'll accumulate to allow her to pay for some things that she needs. It's also tax time. Tax refunds are coming up. Could a portion of the tax return that she gets go into an ABLE account? You know, it doesn't mean that she has to spend it all. She can save part of it. Or what about the Earned Income Tax Credit? The Earned Income Tax Credit allows people who, whether they're disabled or not, they just have to have low income. I believe they're allowed to make up to $14,000 per year, where they can utilize a credit on their tax return to reduce their tax liability. So she might be able to have a little bit more money coming back to her by using a Earned Income Tax Credit. I believe that somebody who is single can make up to $14,000 per year, still qualify for their Earned Income Tax Credit, and it could reduce their tax liability by up to $800. So using a tax credit could also allow her to have more money to put into a savings plan. So first thing that the client needs to understand is that there are a wide variety of options for them to accumulate savings. Just because they don't have a lot of money doesn't mean they can't save. So what are some of the advantages of savings plans? And these come from the Your Money, Your Goals toolkit also. So the client has a peace of mind in knowing that money is there as they need it. If there's an emergency, if there's an unexpected expense, the client doesn't have to stress out thinking about where they're going to come up with the money because they've already got a little nest egg saved for emergencies or a rainy day fund or whatever they want. It's a lot less stress knowing that they've got the money available when they need it. It gives the client a sense of accomplishment in seeing their savings build up. It shows them that they are reaching their goals and that they are capable of saving and that they are capable of reaching their goal that they set. You know, it's a motivator for them to continue to save and continue to work hard to build up those accounts. They have a sense of accomplishment. They also obviously, and this is a big one, you know, for not just clients, but for anybody listening to this, obviously saving money. You save money on interest by avoiding having to charge things or take out loans. You have the money there, you have the cash on hand, you can pay for it without paying for interest charges and all the other added fees that are associated with credit cards or loans. So a client is much better off develop a savings plan when when possible. So what I wanted to do now was go through, this is page 92 of the Your Money, Your Goals toolkit, and it talks a little bit about comparing the situations that a client would be in if they could pay cash for something as opposed to having to take out a loan. And I wanted to go through this because this is just staggering, and this is something that a client or a counselor, a VR counselor, or a WISA could show a client to show them how staggering the penalties can be if they're in a situation where they have to take out a credit card or a loan. So in this scenario, the Your Money, Your Goals folks have used a sample scenario of a client needing $350 for car repair. And so they have 3 different columns here. Whether a client uses emergency savings to pay for that car repair, a credit card, or a payday loan. So obviously the first column is just the amount needed, $350. Obviously there's no APR on paying cash or something. Credit card, just for an example, is 15.99%. And that's kind of on the low end. Obviously, that could vary depending on a client's credit score. It could even be higher than that. Payday loan charges $15 a day for every $100 borrowed for 14 days. That means a 391% APR. Now, a lot of our clients fall into those traps where they do, title loans or payday loans, and they're paying double or even sometimes triple of what even a credit card costs. So if a client has the ability to develop a savings plan, whether it be a PASS or an ABLE account or an IDA, if they want to save for a home or start a business or pay for education, those things would allow them much more financial freedom and flexibility than having to repay a payday loan when they have an emergency and they need cash quickly. And if you look at the repayment terms, obviously there's no repayment term for cash. If a client has a charge that they put on a credit card, obviously they've got to meet a monthly payment at least every month. In this example, they use $25 a month, but if a client has a large balance, the minimum payments might be $45 or $50 or even more per month. And that's an ongoing expense that the client has to work in their budget. Payday loans are even worse. They've got to pay back the loan of $350 plus a $52.50 fee within 14 days. What if a client has another emergency come up and they're not able to repay that payday loan? Then they're going to run into issues with that lender. Next column is total interest and fees. The credit card, you're looking at paying $40 a month more over the next 16 months. So it's going to take the client a little over a year to pay off what they charged on that credit card, as opposed to if they had a savings plan, they wouldn't incur those extra charges. And then the payday loans, again, worse, $52.50 for each 14-day loan. So if they have multiple loans, you're looking at extra fees of over $100 that the client would not have to incur if they just developed a savings plan. So the time to repay, obviously, there's not going to be any repayment if the client has the ability to pay cash or something. But if they have a credit card, they're looking at paying a minimum payment for at least 16 months, and then they only have 2 weeks to repay a payday loan. And so the total cost of the auto repair, if a client has to put it on a credit card or get a payday loan, increases. Obviously, it's only $350 if they pay cash, but now their $350 car repair bill has become $390 if they charge it on the credit card. And again, that's on the low end with a low monthly payment, low interest rate could be more. Or it could go up to 400 and 250 for a payday loan, which is even more obviously. So you're looking at minor expenses ballooning to much higher if a client has no savings. And that obviously increases the client's stress. If they have no savings, obviously it's stressful enough to figure out where the money is going to come from. But then if they take a payday loan, they only have 14 days to repay it. Not only are they paying extra fees and interest on that loan, they've only got 2 weeks to pay it back, and that's a big stressor for folks. So just wanted to go through that chart to just kind of compare some of the different ways a client could pay for an expense. And this is good for a client to see this comparison because it really puts in black and white just how much more they could be paying if they do something spur of the moment like a payday loan. And a lot of our clients do fall into those traps. Just bear with me for a moment here. I want to go through some of the Your Money, Your Goals tools for this module. And I just have to get there. All right, tool number one is the savings plan. And this is a questionnaire that the WISA or the VR counselor can go through with the client either at intake or as they start working or increase their hours, get a raise. There's no specific time that this needs to be done, but this is something helpful if a client has a goal of establishing a savings plan to determine how much they need to set aside and so forth. So let's just go through some of the questions. Do you have the savings you needed to reach your goal? Yes or no? Do you have money set aside for expenses that come up 4 times a year? For example, do you have enough to pay your car insurance, renter's insurance, tools for your trade, expenses related back to school, birthdays, holiday presents? Yes or no? Do you have money set aside for emergencies like medical bills, flat tire for the car trouble, fridge or stove breaks down, they need to replace it? Do they have the money for those things? Do they have enough to meet their expenses for months or weeks with no income? So, for example, if somebody has maybe lost their Social Security benefits because they're making over SGA, if they're on SSDI, or they're making over the SSI threshold, if they were to lose the job, did they have enough money saved up to meet their living expenses until they can get their benefits reinstated? And so it says, if you answered no to any of these questions, developing a savings plan may be a great step. So that's one of the good things about this is that it's very basic, yes or no questions that a client can use to determine their need to develop a savings plan. And then once the WISA or the VR counselor goes through this questionnaire with a client and sets their goal of developing a savings plan, then the WISA or the VR counselor can go through some of the strategies I talked about in a minute and how to do that, such as utilizing work incentives like the SEIE, the PASS plan, the ABLE account. Next part of the questionnaire has to do with clients who answered no to any of the above questions. So if they say, no, I don't have enough money for my living expenses if I was to lose my job or my benefits. No, I don't have enough money for emergencies or if something breaks down. This asks, for questions above to which you answered no, how do you pay for your goals, expenses, and that come out 1 to 4 times a year, and unexpected expenses and emergencies? Check all that apply. I don't know. It seems to work out. I don't pay other bills to cover the emergency or unexpected expense, and that's not a good. I'm sure that a lot of people do that. The old expression is robbing Peter to pay Paul. Well, if a client, let's say, can't pay their rent or can't buy groceries for the month because their car broke down and they didn't have the money to pay for the car expense, then obviously they're going to get behind in their rent or their utilities or whatever they're borrowing from. That's never a good situation. That only causes nothing but stress and problems for the client, obviously. I borrow the money from other family members or friends, which can be fine, but if the client doesn't have the ability to repay, obviously that can cause some conflicts within families. That one should be avoided if at all possible. I get a payday loan. Up above, we went through some of the fees and interest associated with payday loans. A lot of clients fall into that trap and end up paying more. Some people pawn things, possessions, things that are very valuable to them, and they don't even get a fraction of what it's worth, but they do it out of desperation. I put it on credit cards. I use tax refunds. I use a hard title loan. Well, any of these things that a client might do to cover the cost of emergencies that come up are never obviously going to be as good or as give them the peace of mind or having the savings of having the cash there to do that. So clients might start thinking about ways to develop a savings plan after looking over this list and thinking about some of the things they could do and some of the things that they could do better rather than just charging it on a credit card, using a payday loan, or borrowing the money from a family and friend. It gets a client thinking about ways they can be more responsible with their money and making them more independent. Next part is the actual savings plan, and this is good to go through with a client so they can have this in writing. So they give you an example here, the Your Money, Your Goals, folks, about how to develop a plan. First column is a savings goal. Or rather, not just what the client wants to save for, but how much do they want to save? For example, they want to put aside $1,000 and they have 10 months to do that. They want to save up $10,000, or I'm sorry, $1,000 in the next 10 months as part of the emergency fund. So they have 10 months to reach that goal. How much do they need to save monthly? Well, they need to save $100 a month for 10 months if they're going to reach their $1,000 target. What are some strategies for saving the amount of money they have going out a month? Well, a client maybe could cut to basic cable. Maybe they don't have to do direct TV where they've got top of the line service and every channel available with all the premium channels and whatever else. They can maybe cut down their cable bill to just the basic. Cut out one fast food meal per week. That might save a family $60. And so that's even more money that they have going into their savings account. And where will the money be stored? In this case, in this example, the client's going to use a savings account. But you could actually go through this with a client to get them thinking about how much do you need to save? What's your goal? How long is it going to take you to get there? How can you cut out some of the expenses that you have to help you reach that goal, and where are you going to put it? Some people have that like rainy day fund, the cookie jar where they put the money in and just leave the cash laying around the house. I wouldn't recommend that because people get tempted to dip into that savings if they have it just laying around, if something comes up that they want and then they don't have the money there when they need it. So best scenario for a client to do is to develop a checking or savings account or able account or even a pass plan, because pass plans are specifically approved for the expenses that the client wrote the plan for. So for example, going back to our sample case, we said the client in our hypothetical wanted to use the past funds for school textbooks. With an approved pass, the client can only use the money that she's saving for those books, so she can't just have access to use it for whatever she wants. So using a pass is one way to make sure that the savings are safe and that she's not tempted to go in and spend them all, and that it goes to the specific purpose she was saving for. So um, leaving the money around the house is not a good idea. So tool 2 is talking about savings and benefits and understanding the asset limits of needs-based programs such as SSI and Medicaid. And this is very helpful to go through with the client too, just because it gives you some of the different benefits a client may receive. And these are asset limits of as of 2016. The Your Money, Your Goals toolkit was put together in 2017, so this was the most current information available at that time, but it's still helpful in terms of assets because the asset limit for a lot of programs has not changed. But they do give you a hyperlink here, like if somebody got SNAP and they wanted to find out about specific asset limits within their state, they can go to this website, fns.usda.gov, and get the updated income and resource information. But for example, if somebody said, I get SNAP, the federal asset limit is $2,250. So they're aware of that. They have that in the back of their mind when they're developing savings. Or they get TANF, temporary assistance for needy families. They know they can save anywhere from $1,000 to $3,000 in most states without impacting their eligibility for the temporary assistance. Now, it says here in Virginia that they have no asset limit, so a client that lives here would not have to worry about that. Client gets SSI. Obviously, the asset limit is $2,000 if single or $3,000 if a client is married. Now, those asset limits have been the same for, I think, 25 years now, so everybody knows what they are. So typically, without an ABLE account, asset limit is $2,000 or $3,000, depending on the person's marital status. But again, there's a little blurb on the ABLE account, which I went through just a little while ago, that individuals with disabilities onset before age 26 are now able to save up to $14,000 annually. That's an old figure. It's gone up to $15,000 as of January 1st. And again, any money that is put into an ABLE account does not count against that $2,000 resource limit. And the hyperlink just gives you people contact information for Social Security if they wanted to apply for benefits. I get SSDI. Obviously, SSDI has no asset limit. Client doesn't have to worry about how much they're saving. Another couple needs-based benefits a client might get is public housing and like low-income heating assistance or HEAP. I get questions a lot about how, if a person has an ABLE account, we know that the money put aside does not count against SSI or Medicaid, but I get questions about how ABLE accounts impact public housing or like energy assistance. And unfortunately, we have not gotten any guidance on that yet. The ABLE National Resource Center that oversees the ABLE account on a national level has not gotten any guidance from the Department of Housing and Urban Development and how an ABLE account is treated in terms of public housing. So that I don't know. And then the last one is Medicaid. So that's part of this checklist is just a good idea to get a client thinking about what the asset limits are for the specific needs-based programs they're on, whether they get SSI, Medicaid, HEAP, temporary assistance, whatever it is. Get them to think about how much they can put aside as they have a savings goal in mind. And it just kind of goes on and on. I get extra help with Medicare Part D, which is the part of Medicare that helps people on SSDI pay for their medications. I get Medicare savings programs, which pays for their Part B premiums. So there's a wide variety of things that, like WISA, especially that's specifically trained in work incentives and benefits, could go through with a client this checklist to get them thinking about, okay, so you're on like the Medicare savings program or you get a low income subsidy. Let's look at how much you're allowed to save before eligibility for those benefits are impacted. Tool 3 is finding a safe place for your savings. And this is just kind of a list of different things that a client could do just to try to safeguard their money, like a secret place in your home. Benefit is no cost to maintain it, easy to access and convenient. Like I was saying before, I think personally that it's a little bit too convenient. People might get tempted to dip into that if they just got the cash laying around the house. But some people, that might work for some people. If it does, great. But I wouldn't recommend it. The risks are obviously it can be lost, stolen, or destroyed in a fire or natural disaster. And, people find out that you have money laying around the house. It could increase your um, possibility for a crime happening. They could also leave it with a family and friend. Doesn't cost you anything, but it can be stolen, destroyed. A family member could unfortunately take advantage of somebody, trust a family member with their savings, and then have it spent on them and not have the money there when they need it. They could also put the money on a prepaid card, like a prepaid debit card. The benefit is that there's no bank needed, easy access, convenient. The risks are that they might have like an activation fee or fees for using the card, so that there might be costs associated with doing that. If they put it in a checking or savings account, the benefit is like unlike just having cash on hand, they don't got to worry about it being lost or stolen or destroyed. They might have to pay some monthly maintenance fees on the checking account, but they can make sure that their money is safeguarded and secure. Savings bond. An ABLE account is not on that list of things that Your Money, Your Goals folks recommended that people could do in terms of safeguarding their money. But I personally believe that if a client is eligible for an ABLE account, that's the best place for their money. It doesn't count towards their benefits, easy to set up. The fees are very minimal. I think the fees are like $35 per year to do an ABLE account through Virginia 529's Able Now program. So it's not that much. Fees are low, money safeguarded. They can use it for just about anything they want related to their disability, and they don't have to worry about the money getting lost or stolen or being tempted to spend it on things unrelated to what their goals are. So that's kind of a handy dandy list to go through with a client about ways to safeguard their money. And tool 4 talks about the earned income tax credit. And I just wanted to touch on this again. I talked about it briefly a little while ago, but it tells you about like free tax prep ways that clients can save money on doing that. The Volunteer Income Tax Assistant or VITA program allows people who are low income, disabled, or not to go in and have their taxes prepared for free and filed by trained tax professionals without incurring the cost of like an H&R Block or a TurboTax or anything like that. So that's one way a client can save a little bit of money. There's a link here on the Your Money Your Goal webpage on page 113 to the IRS Treasury, where the client can find the local VITA site within their area or the number they can call for more information. The Earned Income Tax Credit, or the EITC, is kind of what I was alluding to a little while ago. It's a benefit for people that have low to moderate income. Refund is based on filing status. And there's a little chart here about whether or not a client has children. Obviously, if they have children, they're allowed to make a little bit more money and still utilize the credit. But like for our example, going back to our hypothetical, we said that the client was young. We'll just assume she doesn't have any children. She's just on her own. In terms of this, at this point, a client was allowed to make up to $14,880 per year to get the credit. If they were married filing jointly without children, it would be $20,430, and the maximum tax credit would be $510. So their tax liability would go down by that amount if they were able to use that credit, maybe increasing the refund a little bit, allowing them to have a little bit more money to put into an able account or other kind of savings plan. Now, again, this was published in 2016, this Your Money, Your Goals Toolkit. This is the most current version, so these numbers probably have changed a little bit. And that's why they give you the hyperlink down below. It says this information changes every year. To make sure you have the most current information, visit irs.gov, and that'll give you the information on the earned income tax credit. So let me just see if I can go there quickly, just to see what comes up. See if they have any, oh, and it says it's not found. Right, well, that doesn't really help us, but I will see if I can get that information out to anybody that's interested. Just shoot me an email after you listen to this if you're interested in getting the updated earned income tax credit information. I'll see if I can get that for you. Next section of this tool talks about the child tax credit. The child tax credit reduces the taxes you owe by up to $1,000 for each qualifying child, and it gives you some of the criteria for that one. Again, you guys are WISs and VR counselors that are listening to this. You don't have to be like a tax professional or a tax preparer to, just share information about these credits. The client can go ahead and investigate that on their own. This is just more of turning them onto a way that they can maybe save more money. So don't expect you guys to be professionals or help people prepare taxes or anything like that. Just something to be aware of, that those credits are available for people that are low income and have disabilities. That's it for the Your Money, Your Goals toolkit. Next thing I wanted to do was go through a tool on the Your Money, Your Goals Focus on People with Disabilities guide. And what this has done is this has taken a lot of the tools that you'll see in the Your Money, Your Goals toolkit and made them specific to people with disabilities. That's why it's called Focus on People with Disabilities. The Your Money, Your Goals toolkit can be used by people with disabilities, but that's pretty much available to anybody that has financial goals and wants to develop savings. Those tools can be used by anybody. The ones on the Your Money, Your Goals Focus on People with Disabilities guide are tools that can be used specifically for people with disabilities. And what I wanted to do, the tool for Module 2 on this guide is talking about how to set up an ABLE account. And it gives a little narrative here about what to do and what to say. For people with disabilities, saving may not seem to be an option that's available because when people receive public benefits, they have asset limits, which we all know. It goes into talking about how ABLE accounts can potentially exclude some of those resources from those asset limits. And it gives the VR counselors and the WISs a little tip on how to explain what an ABLE account is to a client. So if a client has any questions, I've heard of this ABLE thing, what do I do? How do I set it up? It just gives you little tips. Like an ABLE account is a way for people with disabilities to save. It could be an option for you. It's important that you understand how it works. Let's look at how it works and whether setting up an ABLE account is something you'd like to consider. Okay. So one of the ways that it could be used in a real life scenario, let's go back to our client Jane, who's 20 years old and has expenses related to school. She doesn't really have that much savings. She only got about $100 a month left after she pays all her bills. And she goes to her VR counselor and says, I want to know more about this ABLE thing. And what is it about? What can I do? The VR counselor can go through this tool with her, help her kind of compare different ABLE accounts, or maybe even make a referral to the WISA, and the WISA can screen eligibility for it and set the client up with an ABLE account from there. But the next page talks a little bit about helping a client understand what ABLE account is by explaining like the eligibility criteria, and it answers some of their frequently asked questions. So again, it goes through some of the things I talked about earlier, like the eligibility criteria for an ABLE account is having an age of onset of disability prior to age 26. And that doesn't mean that a client who is older than 26 can't develop an ABLE account. It just means that a client has to be disabled prior to age 26. So if a client, let's say, is 50, but they got into a car accident when they were 25 and they've been on benefits all this time, because the age of onset was prior to the age of 26, they can set it up even though they're 50 years old. But what's some of the criteria? You meet the Social Security's definition of disability. So if a client is on SSI or SSDI, they're automatically found eligible for being disabled under the ABLE program. However, a client does not have to be on benefits to be found disabled under ABLE. If they have a physician's statement that says, yes, John Smith is my patient, and I verify, the doctor says, I verify that he's been disabled since birth or whatever, that's sufficient enough to make the client eligible for an ABLE account. They don't have to be receiving SSI or SSDI in order to do that. Next thing gives a few examples of disability-related expenses. And like I said earlier, this is very broad in terms of what a client can use the ABLE account for. Some things like education, housing, transportation, employment training and support. Assistive technology is one. And actually, the first training I did on Your Money, Your Goals in the fall was on paying for assistive technology and devices. I did a whole webinar on tools from Your Money, Your Goals toolkit, and from this one on focus on people with disabilities on assistive technology. So if you're interested in obtaining an archive of that webinar, shoot me an email and I'll get you that and all the materials that went with it. But assistive technology is often obviously something that people with disabilities often need. Sometimes they can get help paying for those expenses. Sometimes DARS can cover the cost of certain things, but obviously, DARS can't buy every single item for every single person that walks through the door. That's not feasible for us. So an ABLE account could be a way to pay for some assistive technology that the client needs that maybe DARS cannot pay for. Other things that weren't previously mentioned, but like personal support services, if people have um, costs for like home care aides and things not covered by Medicaid or Medicare, other insurances, the ABLE accounts can be used for those sort of things. Financial management and administrative services and other expenses to improve health, independence, or quality of life. Because the regulations have quality of life in them, a client could even make an argument that, going on vacation could be something they could use an ABLE account for because it does improve their quality of life. It gives them the opportunity to get out and see something different, to do something different, what have you. Okay, so the next part talks about minimum contributions. Um, this varies based on the requirements of each state program, but it is generally $25 to $50. And in Virginia, I do not believe that there is a upstart cost for Virginia's Able Now program. And not every state has a program, but I think we're up to like 40 states, though, and DC that do have an ABLE account program. So the program structure and fees to set up the accounts, fees for ongoing maintenance are going to vary by state, but in Virginia, I don't think that we have a minimum contribution. And this is, can you continue to make regular contributions to an ABLE account once it's open? Regular deposits may not be required, but regular contributions to savings can help you grow your savings faster. They don't have to save every month, but obviously the more that they can afford to put aside, the faster they're going to reach their goal. When considering setting up an ABLE account, be sure to research how much will be invested through an ABLE account. So there are options for people to invest in like stocks and things like that. That's not required, but they can put aside part of their money into other investments if they want to take a risk on getting a return on their ABLE investment. So that's what it needs by how much money will be invested, how much is it going to cost to open it up, and for ongoing maintenance. Whether there are advantages available to in-state residents is another one. I believe that there is a tax break on the Virginia tax return that if a client or a client's family member did contribute to an ABLE account during the course of a year, there is a tax break for people that live in Virginia on their Virginia income taxes that they can take. So in Virginia, there would be a tax break there. Maybe that's an incentive for a client to set up for Virginia's Able Now program. The rest of the tool is just comparing different programs. And just because somebody lives in Virginia does not mean that they have to go through Virginia's Able Now program. There are many states that are, like I said, that have ABLE programs. Many states offer clients to enroll in an ABLE account regardless of where they live. So, for example, I think Virginia is one state where somebody who does not live here could potentially qualify for an ABLE account in Virginia. They don't necessarily have to go with the ABLE program in the state where they live in if they want to go for another program that's more advantageous for them. Certain states do have an in-state requirement. I know that Florida stands out as one. You have to be a Florida resident to participate in Florida's ABLE program. But in a lot of states, it doesn't matter where a person lives as long as they meet the criteria for an ABLE account. They can go to whatever state they choose. So this is a kind of chart that the client can use to kind of compare the different programs. Like where is it, what state is it located in, who administers it, are there benefits if you live in state. Like I said, one of the benefits for a client living in Virginia to develop a Able Now account here is maybe a break on like state income taxes. Are there state tax breaks for people who contribute to the account? Like I said, I believe there are tax breaks for like friends or family members of the person who has the Able account set up to receive tax breaks too. What kind of investment options do the programs that the client's considering offer? What are the fees for ongoing maintenance and startup? Are there limitations on disbursements from the account? If so, what are they? Like in Virginia, I don't believe that there are those such limitations. In some states there might be, but I believe in Virginia clients are able to withdraw as much as they need at any given time. Does this program offer a debit card? And if so, what is the fee to use it? In Virginia, for Able Now, the client would get they call it a Able Now debit card that they could use. It's kind of like a prepaid debit card almost, where the contributions from the Able account would be available on that card, and then they could use it if they go to the grocery store, or if they need to use it at the gas station or wherever they're going. They can kind of just swipe it as a credit card, and then the amount of money that they spend would be deducted from the Able account. So Virginia now does have that debit card option, easy and convenient for a lot of people. Does the program offer checks? And what other features are important to you? So that's just kind of a way for a client who's interested in the Able account to compare some of the different state programs. And as a VR counselor or a WISA helping a client set this up, this is kind of a way to put the responsibility of finding this information back on the client a little bit, making them a little bit more independent. If you want to set up this Able account, go back, do some research on some different programs, and come back to me with the results. So it's just a way to make the client a little bit more accountable and responsible for their part in getting the Able account set up. So those are the tools on the CFPB Your 1 Year Goals Focus on People with Disability guides for this module. And that pretty much completes the webinar. I want to just finish up by making a couple of announcements again. If you're a VR counselor, don't forget to email me if you want CRC credits. Don't forget to log in your participation in this. If you're a WISA and are certified through Cornell, make sure you're continuing ed. The next webinar is going to be on February 28th between 1 and 2, and on Module 3 on tracking and managing income and benefits. And I'll be going through some of the tools that allow clients to track how much they have coming in and how much they have coming out. I'm sorry for having to do this webinar in advance, but again, like I said, I wanted to just make sure that I did this while I had a stable internet connection. I'm sorry that I can't do a question and answer session in this format. However, if you do have any questions after listening to the webinar, I am available at any time. Please feel free to email me, Michael, MICHAEL, .klinger, KLINGER, DARS.virginia.gov. Be glad to answer any questions you have about the toolkit. You can call me 434-298-7652. Glad to walk you through any questions you have on any of the tools. Also, before before I end the webinar, I want to let you know that any of the information in the Your Money, Your Goals toolkits or Focus on People with Disabilities guide are available in hard copy, and those are free. So if there are any WISs or VR counselors on the line that would like to order materials in hard copies, to maybe make some copies of some of the tools to use with your clients, let me know, and I would be glad to send you the information on how to enter, how to order the electronic copies too. Those are free, and I can get you as many as you'd like. So if that's something you're interested in, please let me know. All right, I thank you for your time and listening to this webinar, and I look forward to the next one on February 28th. Hope you have a great day. Bye-bye.